Hello and welcome back to another episode of the Direct Advisors Retirement Plan Podcast. I'm Stacy Gregory, a plan advisor with Direct Advisors, and today I want to talk about the contribution limits and eligible compensation restrictions within qualified retirement plans. Now, many of you may be aware that you and your employees can only contribute up to a certain dollar amount each year. But did you know that as a highly compensated employee, you may be even further restricted from contributions? And were you aware that there are limits to both how much the employee and the employer may contribute? Let's take a closer look. I'd like to preface these numbers by saying that they will change over time. We're going to cover the numbers as they stand in 2020, but each year these figures are reevaluated and may be updated to reflect changes in inflation. In 2020, employees may defer from their paycheck up to $19,500 to their retirement account. These can be pre-tax dollars or Roth dollars if your plan offers this feature, or a combination of the two. And anyone over the age of 50 can make what's called a catch-up contribution. This is the ability to contribute an additional $6,500 to the retirement plan for a total deferral of $26,000. It's worth noting that the figures I'm reviewing today apply to 401ks, 403bs, and 457 plans. But if your company offers something like a simple 401k plan, you'll have different limits. For example, simple 401ks limit employee contributions to $13,000 in 2020, with a catch-up contribution of $3,000 for anyone over the age of 50. Now, the numbers I just covered apply to employee deferrals only, so money from the employee's paychecks. But in the event the employer is doing a contribution as well, there's a whole separate limit that applies. And for 2020, that number is $57,000, or $63,000 for those qualifying for the catch-up contribution. This is the total amount allowed to be deposited into the retirement plan when combining both the employee and employer dollars. And I'd like to note that this limit does not include any rollover dollars that an employee may have rolled over from a previous retirement plan. And I mentioned earlier that compensation plays a role in deferral limits as well. In 2020, eligible compensation is capped at $280,000. This means employees may not defer income on compensation earned above this limit. And there's one other very important way compensation plays a role, and that's in relation to those who are deemed highly compensated employees. These employees or owners face further restrictions. If you're unsure who's considered a highly compensated employee, you'll need to contact your third-party administrator, your TPA, to clarify. For 2020, someone's considered a highly compensated employee if they've earned more than $130,000 or own more than 5% interest in the business. And this can quickly get complicated though, since your percentage ownership also includes ownership held by a spouse, children, or grandchildren, for example. You may only own 2% of the company, but if your spouse owns 4%, you are now over that 5% threshold and considered a highly compensated employee. And there are other ways that someone may be deemed a highly compensated employee as well. So again, please clarify with your TPA. Now, if you or anyone else is deemed to be a highly compensated employee, you'll be limited in how much you can contribute based on parts of non-discrimination testing, which is conducted each year. This is to help ensure that the retirement plan doesn't favor highly compensated employees over the rest of the company. But you may be able to avoid this testing if your company does a safe harbor contribution to the plan. To pass this discrimination testing, average contributions made by highly compensated employees can't be more than 2% higher than average contributions made by non-highly compensated employees. So, for example, if the average contribution non-high comps make equals 4% of their salaries, then the average contribution that high comps make can't exceed 6% of their salaries. And in addition to this, highly compensated employee contributions as a total can't exceed 2% of the total contributions made by non-highly compensated employees. As you can see, how much you and other highly compensated employees can contribute to your retirement plan depends heavily on how much non-highly compensated employees are contributing and how many are even participating at all. Don't worry though, you don't need to do this math on your own. Your TPA can provide the contribution limits to you each year. But since this calculation is done at the end of the year, a highly compensated employee may have contributed more than they were allowed to. In this case, some of the deferrals will be refunded, and this may trigger a tax liability in the event they were pre-tax deferrals. If you or your employees have questions on how much can be contributed to the retirement plan, we encourage you to reach out to the team at Direct Advisors to discuss this further. We can be reached by phone at 518-362-2119 or by email at info@directadvisors.com.